Hey everyone, welcome back to Corporate Decoder. Today we're diving into a report from QDM International, and trust me, this one's a wild ride. Think high-stakes international finance meets Main Street. So buckle up as we explore what's really going on with this insurance brokerage company operating out of Hong Kong. Right off the bat, this is an amendment to a registration statement, meaning QDM is trying to get its stock listed on the Nasdaq exchange, a major step up from where it currently trades, but there are some serious risks involved. QDM believes it'll meet Nasdaq's listing standards after this offering, but approval isn't guaranteed. That's a big deal because a Nasdaq listing usually means more investors and higher stock prices. Here's where things get interesting. The company is based in Florida, but its primary operations are in Hong Kong, which is a special administrative region of China. This creates uncertainty because the Chinese government could decide to intervene in QDM's business at any time. The document warns that the Chinese government could limit QDM's ability to pay dividends outside of China, delay the return of funds from this offering into Hong Kong, or just generally mess with their business. Those are serious risks for investors. This filing gets into the specifics of Chinese regulations that could affect QDM. New rules from the China Securities Regulatory Commission, or CSRC, now require companies seeking to list overseas to get approval. QDM argues that because it does most of its business in Hong Kong, it doesn't need this approval, but there's no guarantee that the Chinese authorities will agree. If they don't, QDM could face fines or even be blocked from offering its stock to investors, which would tank its value. There's also the Holding Foreign Companies Accountable Act, a US law that could prevent QDM stock from being traded if US regulators can't fully inspect the company's accounting firm. While QDM's current auditor is based in Denver, if the rules change, this could become a problem. Because QDM is a holding company, it relies on its Hong Kong subsidiary to send cash back to the US. If the Chinese government restricts the flow of money in or out of Hong Kong, that could cripple QDM's ability to fund its operations. Before this offering, there are about 291.6 million shares of QDM stock. After the offering, that number will jump significantly, diluting the value of existing shares. QDM plans to use the $7.5 million from this offering to expand its services, boost marketing, hire new people, and for general operations. But the exact amounts could change and investors won't have much say in how the money is spent. Here's a major red flag. QDM gets most of its revenue from selling insurance products from just a few companies. In 1 year, one company accounted for 96.5% of their commissions. If QDM loses those key partners, its business could be in serious trouble. This section spells out the political and economic risks of operating in Hong Kong. Changes in Chinese policies or even just tensions between China and the US could hurt QDM's business and stock price. The company admits it has material weaknesses in its internal controls. That means there's a real risk that its financial statements could be inaccurate. They plan to fix this, but there's no guarantee they'll succeed. One person, Hui Zhong, controls a huge chunk of the company's voting power. This means he can basically do whatever he wants, even if it's not in the best interests of other shareholders. Don't expect dividends anytime soon. The company plans to use all future earnings to grow the business, not to pay out cash to investors. QDM's results can change a lot from quarter to quarter, which could make its stock price very unstable. Alright, let's peek at some numbers. Jumped from roughly $2.7 million to $5.2 million in 2030 and 2024. A decent jump in cash. Gross profit improved massively, going from about $416,000 to over $2.4 million. But remember, much of this growth is tied to external factors they don't really control, such as post-pandemic travel. General and administrative expenses also increased from $374,000 to $652,000. Higher expenses with higher cash can be alarming, but seems to be that this company hired more people to increase their sales force. Now, let's jump to the unaudited financial for the last 9 months. Total revenue fell by 33.8% compared to 2023. Cost of sales decreased by 82.3%, which is why the gross profit margin increased by 45.3% despite the revenue falling, which is good. Tax expenses increased by 52.6%, but that was because of increase in profit. Tough too, so what's the verdict on QDM International? Well, on one hand, it's a small company trying to make a big leap by listing on the Nasdaq. The potential for growth in the Hong Kong insurance market is certainly there, but there are significant risks. The regulatory environment in China is a huge question mark, and QDM's reliance on a small number of insurance partners makes it vulnerable. Plus, the internal control weaknesses are concerning. Looking past the potential, investors should really take a long look at the risks. There are probably better opportunities out there that are less risky. Thanks for watching. If you found this helpful, please give us a like, drop a comment, and subscribe for more deep dives into the world of corporate finance. Until next time.